Amazon has finally been added to the Dow Jones, which means it's going to replace one of the 30 companies in the Dow Jones. Now, the Dow Jones Industrial Average is not nearly as important as the S&P 500. So when you're looking at this move, is it going to have any major impact on Amazon? No. To put it roughly in size, the Dow Jones is around 1/100th of the importance of the S&P 500 with the amount of indices that are benchmarked against it. So this may be a small move, but it does still have some symbolic meaning. Amazon is replacing Walgreens in the Dow Jones, but it's also somewhat replacing Walgreens in real life. The reason that Walgreens is doing so poorly, losing revenue, losing market share in what they compete in, which is having them on the corner of streets. You can go in and get all these little items that you need, little healthcare items, beauty items. Well, that's largely being replaced by Amazon. So Amazon is both replacing them in the Dow Jones and somewhat replacing them in real life. Now, Amazon has been on a bit of a roll. If we look at the company here, just year to date, it's up almost 17%. So a huge gain this year. Investors are very excited about Amazon. If we go to the trailing 1 year, this stock is up 86%. A massive winner over the trailing year. So Amazon is on a big roll already. It's up to $175. It seems like yesterday this stock was trading at $80 or $90 per share. I remember having discussions on my Discord and with community members of what price we're going to continue buying it at. It's now below $100 per share. And we were adding to our positions at that time, having a bit of hope that the company would recover. And of course, Amazon has recovered. A lot of the metrics are moving in the right direction. And I've recently done videos highlighting that I believe Amazon will have explosive free cash flow growth this year. We've seen a bit of a glimpse of that the previous quarter, but we're forward looking. We want to see what's going to happen this year. And we have an analyst here. His name is Mark Mahaney. I've showed him on the channel before. Out of all the analysts you can follow, I think he's pretty good. I think he's one of the good guys. Mark Mahaney just went on an interview and raised his price target from 180, which is close to where Amazon trades right now, to 220, which is around a 25% increase. So he bumped up the price target for Amazon quite a bit, and he explains in this interview 5 different reasons he believes Amazon is going up. Now, before we jump into the interview, I first want to disclose that I do have a large position in Amazon. It's in my story fund portfolio. This is my smaller portfolio that I have a couple handpicked companies. And Amazon is my largest investment in this portfolio by far. In fact, it's one of my largest individual holdings in general, just in any portfolio. Amazon is now a massive $73,000 position. That's a lot for a single stock for me. So this is a big, significant bet. I've owned this company for a while. I'm really bullish on it. And it's interesting to see some stock analysts and people like Mark Mahaney now moving their price upwards. So having said that, let's go ahead and take a look at this interview. Now, another thing to mention before we jump into this interview is the audio when Mark Mahaney's speaking is not great. It's hard to understand. He needs a better setup. He needs a microphone or something better because he's difficult to understand. I'll try to do some editing and maybe I can make it more clear, but I'll also try to just state some of his most basic points to make sure you hear it. So having said that, let's go ahead and jump in.
Yeah, so I think we took our price target up from 180. This was all on the earnings.
He says, first of all, that he took the price target up from 180, and it's currently at 220, which is a 25% increase.
Report a few weeks ago. Amazon's currently our top pick in the large cap internet.
Now, another thing he mentions is that Amazon is currently his top pick. Now, that may not mean much to you if you don't know his history, but he's had some pretty good top picks. His last one, his most recent top pick was Meta, which did really incredibly well over the past 2 years. He had that as a top pick basically the entire time. But now he switched over from Meta to Amazon, having this company as his top pick.
If you step back, the reason it was added to, I assume, the index was it's one of the broadest representations of the economy, and you've got a pretty consistent financial track record. The company's also at something of an inflection point. I think this year you're going to get record high free cash flow margins, record high retail operating margins, and you're going to get this acceleration in the AWS cloud revenue growth.
So he just named off 3 different things so far that he thinks are going to be really good things for this year. The first one is record high retail operating margins. So the retail portion of the business should be at a record high margin this year, and Andy Jassy has done an excellent job upping the margins of the retail business. He also says that he thinks they'll have record high free cash flow margins, which is another thing I fully agree with. I said before that I think Amazon will generate around $70 billion of free cash flow this year, which is a huge increase, a lot over any previous year. And I think that will happen from a combination of all of their margins increasing from retail, AWS, their ads business, by virtue of their CapEx, their huge spending, going down incrementally. So I agree with him again on record high free cash flow margins. And then the last thing he points out is that he believes AWS is going to reaccelerate in 2024 over 2023, which is a clear trend we see. So all of these things coming to alignment at the same time. Retail margins, we have free cash flow margins, we have AWS picking back up steam. He believes all of those are very good short-term catalysts for the stock. And then he goes on to point out how Amazon is also just a company that has its hands in everything, that can benefit from all of these type of things moving in the right direction.
Amazon's always presented as this company that gives you the kind of the leadership in online retail globally with almost $1 trillion in sales. And then now we're at $50 billion in ad revenue. So it's the third largest ad platform in the world, and then it's the largest cloud platform in the world. So this is kind of one of your broadest reads into the health of the consumer, the health of enterprises. It's one of the reasons we like Amazon, but it's kind of a leader in these really large TAMs or total addressable markets. It's one of the reasons it's our top pick.
So he highlights that another reason he likes Amazon as his top pick, and this is something that I pointed out many times, is companies that already have dominant market share tend to do really good in those markets. Netflix already has dominant market share streaming, and guess what company's doing well in streaming? You have Visa and MasterCard. They already have dominant market share in digital processing of payments. Guess what companies are doing well in those categories? Visa and MasterCard. Then you have Amazon. Amazon is a big player in a couple big markets. They're the biggest player, the most dominant position in online retail. Try to name off who's second place, like Walmart, Target. You have Shopify, that's a tiny player against them. Amazon controls the dominant position of a highly concentrated market share, 40% of a total addressable market. Online retail is massive. So they're the biggest player in that. But then you also have the market of cloud hosting. That's not going to go anywhere for a long period of time. And even the developments in AI are still going to benefit from cloud hosting. And Amazon is by far the biggest player. People look at the growth rates of Azure and cloud. They say that they're growing faster, but every single quarter, Amazon has more total dollar growth than both of those companies. They are growing cloud huge every single quarter. The percentages are smaller, but Amazon is already at much bigger scale. So Amazon has the dominant concentrated position in cloud hosting, huge market share there as well. And then you have advertising, something that Amazon just came up with a few years ago. And now it's almost a $50 billion per year business. They are the third largest advertising company in the market. So we have another highly important, huge total addressable market that Amazon finds itself having a large percentage of. So you have this company is not only one where everything's really accelerating, margins are moving to all-time high, you have all of these short-term catalysts, but then you have the long-term structural position of the company, being this massive, dominant player in multiple market segments. And that's what I find attractive about this stock. I look for companies that are already the winners and they're going to win more in the future. I think Netflix is one of those. I think Visa and MasterCard are ones. I think companies like S&P Global and Moody's are one. And I think that Amazon is one in multiple businesses. Now, if we jump back into this interview, another thing he mentions is that Amazon is becoming easier to value. And being easier to value does affect the price. So let's go ahead and listen to why he thinks the company's now easier to value.
What happened to Amazon is they went into a major investment cycle as they aggressively invested in next day, same day, several hour delivery. And that really trashed its free cash flow margins. It actually went 2 years of negative free cash flow. But you're out of that cycle. That made valuing the company several years ago very challenging, where you had to go out several years in order to value it. You don't need to do that now. Cash flow is abundant at the company. Free cash flow multiple is very realistic.
So he accurately points out one of the recent problems with Amazon. The company was difficult to value because it was losing cash. It was burning $17 billion and $20 billion in free cash flow per year, 2 consecutive years of losses. And you're trying to figure out as an analyst at a bank or as a retail investor, what is this company worth? To know what the company's worth, you have to be able to predict what the future cash flows are. So making an approximation of what the future cash flows are for a company that's losing $20 billion in free cash flow is very difficult, especially one like Amazon that is large and vast and has many different businesses. You have to try to do valuation on all of these type of things at the same time. This makes the job of the analyst very difficult. And I think most analysts are a little bit conservative. They're not able to accurately predict the operating leverage in the business. So Amazon was very cheap last year when it was losing cash. This year, if it generates a lot of cash flow, it'll become very apparent what the valuation is, what the company's actually worth. So he's stating that as this company has cash flow and generates free cash flow, the valuation job is easier. And if the valuation job is easier, the stock should be more appropriately valued, which he believes right now is undervalued. So I think this is another important point. It shows that the company is probably mispriced right now, but that all depends on this year's cash flows. So he's already gone into some of the short-term catalysts for this year, but he also goes into some of the main drivers of Amazon, the future of this company.
Well, I just think it's a representation. What a long trip we've gone through with Amazon. I've covered it now for I think 27 years, not since its IPO, but pretty darn close to it. And the level of skepticism that stock company faced for its first 10, maybe 15 years as a public company. But the fact that it's expanded so much and it's such a broad play off consumer strength, off of advertising, off of enterprise, and now business to business logistics, potentially pharmacy, Amazon just covers so many different areas, which means it also gets most economically impacted or more economically impacted than most companies. So if there's hyperinflation, Amazon sees it all. But as inflation starts to wane down, Amazon benefits from it all too. So Amazon's really kind of one of your broadest, reads into the economy. It's almost surprising that Amazon wasn't added, maybe a few years ago.
The company is a broad read on the overall economy, and if inflation comes down, Amazon will benefit from that. And he also mentions that Amazon's continually moving into other categories, which we see them doing again with pharmacy, for example. Maybe that one's not successful, maybe it's not such a big deal now, but remember, just a few years ago, the advertising business wasn't such a big deal. Now it's a $50 billion high margin business. So Amazon can spawn these different businesses seemingly out of thin air just by the way that they expand, the way that they grow, and their huge market share. So I'm still bullish on the company. I was excited to see one analyst on board raising price targets for Amazon. Hopefully the company does well this year, but we'll see. That's all for now. See you in the next one.